In B2B commerce, making a credit sale recognizes revenue on the income statement immediately. However, that same transaction creates a delay on the balance sheet, where actual working capital remains sedentary until the invoice is settled. It appears here as accounts receivable, legally recognized capital but unavailable for the duration of a 30, 60, or 90-day term. This duration introduces two drags: a liquidity delay creating a cash gap, and default risk threatening the firm's solvency. Standard treasury operations require methods to accelerate the turnover of these assets to ensure the firm has the cash necessary for daily reinvestment. Strategic trade finance aims to stabilize cash flows and outsource the burden of credit management, allowing the firm to prioritize top-line growth over debt collection. Factoring and forfaiting serve as the primary structural solutions to this working capital gap. Choosing between these tools requires a quantitative assessment rather than a qualitative preference. Optimized treasury management relies on tracing the precise mechanical flow of capital and identifying the hidden costs of time and risk. We can model these costs from first principles, building a mathematical framework to determine the most efficient way to deploy the firm's capital. This analysis shifts treasury management toward a model based on hard, calculated financial optimization. Factoring is the outright sale of accounts receivable to a financial intermediary known as a factor. The client ships goods to the customer and simultaneously assigns the invoice data to the factor. The factor provides immediate liquidity by advancing a portion of the invoice value, typically 80%, to the client. The remaining 20% is the factor reserve, which acts as a safety net to cover potential sales returns or trade disputes. The cost for this liquidity includes an upfront commission for ledger management and a discount charge, which functions as interest on the advanced funds. Once the customer pays the factor in full, the factor remits the remaining reserve balance to the client, minus the agreed-upon fees. The risk is allocated based on the contract type. Recourse factoring means the client absorbs any bad debt, while non-recourse factoring transfers that risk to the factor for an additional del credere commission. Effectively, the factor provides a bridge to immediate cash, but the value of that bridge depends on the firm's internal cost of capital. To evaluate the efficiency of these options, we first calculate the cost of managing receivables entirely in-house. This creates our baseline for comparison. This cost includes the interest paid on bank loans used to float the receivables, as well as historical bad debt losses, which in this dataset total 1.5% of turnover. We then add administrative overhead, covering the fixed costs of maintaining an internal credit and collections department. Finally, we calculate the opportunity cost of lost sales. When sales executives spend time on collection efforts rather than business development, the firm loses out on the margins of those foregone sales. This baseline reveals that in-house management represents a significant drain on both cash and operational productivity. When we model recourse factoring against this baseline, we can see where the firm reclaims value. The model inputs the factor's commission and the interest on the 80% advance. Because the factor manages the ledger, the firm eliminates internal admin overhead and reclaims margins lost to sales inefficiency. Even though the firm bears the bad debt risk in a recourse model, the total cost is significantly lower than the in-house baseline. We then add a third column for non-recourse factoring, where the factor assumes all default risk. To assume this risk, the factor increases the commission, in this case from 1.5% to 3.5%. This premium removes the bad debt loss from the firm's balance sheet entirely. By comparing these three models, we can identify the net benefit of each approach. In this specific calculation, recourse factoring is the most efficient. The premium for non-recourse protection is higher than the firm's 1.5% bad debt rate. This demonstrates that the choice of financing is a direct arbitration of risk pricing and recovered opportunity costs. While domestic factoring optimizes high-volume transactions, medium-term international trade requires an entirely different, specialized financial architecture to effectively mitigate cross-border risk. Forfaiting is designed to facilitate these cross-border exports. This diagram outlines the forfaiting process, which uses a different mechanical loop than factoring. Structurally, forfaiting provides 100% financing upfront. No reserve is held back from the exporter. It also operates over a much longer time frame, utilizing promissory notes that typically span 3 to 5 years. These transactions are executed entirely without recourse, meaning the exporter has no further liability if the buyer defaults. The forfaiter manages this risk by relying on an aval, a guarantee from a major international bank, rather than the individual credit of the importer. This decoupling removes sovereign and commercial risk from the exporter's books for a medium-term yield discount. Comparing both systems side by side provides a clear framework for treasury strategy. Factoring serves as a tool for ledger optimization and short-term liquidity, mitigating the daily friction of credit sales. Forfaiting provides complete liquidity and risk transfer for long-term international trade. These financial architectures allow Treasury departments to proactively manage the timing and reliability of their cash inflows. By applying these quantitative models, firms can effectively exchange trade credit risks for immediate liquidity, maintaining the capital flow necessary for continuous operation.